What if I will tell you that the most debated question in investing regarding lump sum investment versus DCA, the dollar cost averaging, and the simple answer of that is backed by 100 years old data, 100 years data backed by the 100 years research data. If you are new here, I am Vikas, former private banker and currently on a journey to financial freedom. So in this video, we are going to discuss in detail about lump sum investing versus DCA, dollar cost averaging. So before we start and before I will show you the data, the research data, let me explain you what is lump sum and what is DCA. So it is very simple. Lump sum is if you have $12,000 currently in your account, you go one decision at one go, you invest, that is lump sum. Second, the DCA, dollar cost averaging, you have $12,000, you start investing every month $1,000 till the end of 12 months, you started investing from month 1 to month 12, so that is dollar cost averaging. So let me tell you, before we go to this data, I will tell you who has done this research. So the primarily in this research, the Vanguard, the topmost investment firm in this world, and American Association of Individual Investors, along with the Northwestern Mutual. So they have conducted a research, and according to this research, they have found the interesting data. Whether one should start investing into the lump sum or whether they will invest into the DCA, the dollar cost averaging. So the American Association, they have included data starting from 1926, which is almost 100 years old data, including the Great Depression, the World War II, and market crash during the 1960s, and 2000 dot-com bubble, 2008 recession, along with the COVID, everything they have covered. So here is the data. 68% of the time, lump sum investment outperforms DCA over a 12-month period across US, UK, and Australian markets. This was Vanguard research from 1976 to 2022. 75% of the time, lump sum outperforms DCA over rolling 10 periods, Northwestern Mutual research, 100 years of US data. 2 to 3% average annual return advantage for lump sum over DCA across a 10-year investment horizon. 32% of time DCA wins, primarily during market crashes, high volatility periods, and bear markets. So the data is very clear. The lump sum wins. But let me ask you one thing. Before we go more deeper inside whether this lump sum or DCA method is good for our personal approach or not, let me ask you one clear question. The lump sum investment, if I talk about, let me give you my personal example. When I started, I didn't even knew that what is DCA. I was simply saving my money, whatever I left. Most of the time I didn't had any, but whatever it is left at that time, I started putting into the savings account. Right? So this approach was actually DCA, the dollar cost averaging. If I start that money investing into the markets, that is the simple dollar cost averaging method. Now, if the lump sum is a winner, so one question I want to ask you straight: how many of you have lump sum investment $50,000, $100,000 available at the one go to invest? If you are a salaried person, you are earning wages, 9 to 5 jobs, it will be difficult to have $50,000, $100,000 until unless you have planned previously. So the DCA method is good, right? So rather than going into this debate of whether to invest lump sum or DCA method, The best thing is that if you are opting either DCA or lump sum, you are started investing. You already started investing. That is far better than sitting idle or not investing. So there are few assumptions and there are few things which we need to understand first. So the lump sum investments works very well into the growing market. If the market is growing, if the market is on the bull run, the lump sum will definitely give you very good returns. But what if you have started investing the day in the year 2000? By the end of 2002, let's take an example. If you have invested $12,000 in 2000, January 2000, by the end of 2002, in the dot-com bubble era, your investment would have erosion 40% of your principals, and it is reduced by 40%. So that was, again, it took years to recover those markets, those investments. Second thing, if you started with 1000 average without any panic, without looking at your money, without looking at your investments, without looking at the screens, that whatever you are investing, without the emotions, every month you automated lump sum amount, it is going from your account and it is invested into the account. So lump sum is good when the markets are in uprise. DCA, the dollar cost averaging, is good when the market, during the market crashes, during the recession, the dollar cost averaging is good. However, there are many metrics that in all asset class or in all stocks, we should be cautious. We should be cautious regarding investments, whether to which investment we should opt, which investment we should not. We should go in these things in deeper in later videos. So here the question is, we are discussing whether to start lump sum or dollar cost averaging. So these are the metrics. So how we can do? We have very simple approach. I applied this simple approach to myself, and continuing this journey throughout the last 4-5 years, and this is comfortable. If you have lump sum amount available and if you are comfortable with the market crashes, even if you are comfortable with if market crash for 10, 20, 30% from now, you can start immediately investing as a lump sum. If you are a salaried person, you have a household income, month on month basis, a salary coming in, then you can start investing into the DCA, dollar cost averaging. You can take help from my break free financial toolkit, where the exact method you can apply into the savings and investments portion, where you can mention your dollar cost averaging goal and you can start investing. But before that, this investing, I have recorded a video previously regarding your emergency fund. So the first priority, if you have not built the emergency fund, go to this video and start building your emergency fund first. Then this investing journey you can start. Okay, let me give you a clear example of lump sum and DCA. So if you have invested last week, now it will be difficult for you to understand, because last week market have dropped drastically. The Nasdaq itself dropped around 4.5%. So you will be surprised that if you have the holding capacity and you are emotionally not hit by these kind of drops, then of course you can start investing in lump sum. Apart from that, if you are not comfortable at all, then it is just a 2 to 3% difference between lump sum and DCA method, the dollar cost averaging. So you can start investing in DCA method. So last week, if you have started with $1,000, now next month you will again add up $1,000, then you will continue this journey for throughout this 1 year. So that is the simplest example that you can implement and immediately start investing into the markets. Now, uh, how you can start, very simple way of this DCA method. I personally prefer to investing into the DCA with the DCA method, the dollar cost averaging. First of all, decide what amount is you are going to invest into the markets. Go to the break free financial toolkit. There is what is your safety margin, what is your net margin available. I prefer out of that take home 10 to 15% you start investing. Second thing, automate it. Whatever or whenever your salary comes in, immediately you give the instructions to your bank, 10%, 20%, 15%, whatever amounts you are comfortable with, you start investing into through the DCA method. That's it, simple. This approach I am personally following, and this can be helpful for you guys as well. So, at the end, the homework for this episode is note down your previous investments which you have done, whether they have done with the lump sum or with the DCA method, you are continuing them or not. Write down in a comment you are a lump sum investor or a DCA method investors. Now, that amount which you have saved, 10, 20, 15%. Third thing is comes in the process is to invest. Invest, where to invest? I prefer investing into the broader index funds or ETFs. So we will discuss in detail about index funds and ETFs in coming episodes, and we will discuss how I have started and how the index funds and ETFs works. All right. So I am Vikas. This is Break Free, and I am on the journey to the financial freedom. This is the journey where I want you to walk along with me on this journey. Thank you so much.